Hi everybody, and welcome back to video number 3 in chapter 20. And when we left off, we were looking at an illustration for a finance lease. And we're going to assume that Coffee and Beans Equipment Incorporated and Starbucks sign a lease agreement dated January 1, 2025. And that calls for Coffee and Beans to lease a commercial grade coffee bean roaster to Starbucks beginning January 1, 2025. The terms and provisions of the non-cancelable lease arrangement and other pertinent data are as follows. 1. The lease term is 5 years with no renewal options. Number 2. Rental payments beginning of each year are $20,711.11. Number 3, the leased asset, that's the bean roaster, 1, has a fair value at the commencement of the lease of $100,000. Number 2, its estimated economic life is 5 years. Number 3, the residual value guaranteed is $5,000. And 4, Starbucks expects that it is probable that the expected value of the residual value at the end of the lease will be greater than the guaranteed amount of $5,000. Okay, the equipment reverts to Coffee and Beans at the termination of the lease. Starbucks incremental borrowing rate is 5% per year. Starbucks depreciates on a straight line basis similar equipment that it owns. And lastly, Coffee and Beans sets the annual rental rate to earn a rate of return of 4% per year. Starbucks is aware of this rate. Okay, let's look at those lease classification tests. Number 1. Transfer of ownership does not occur. The assets revert to Coffee and Beans at the end of the lease. Number 2, the purchase option test. There's no purchase option in the lease. Number 3, the lease term test. The lease term is equal to the economic life of the asset 100%. Therefore, the lease does meet the lease term test. Number 4, the present value test. The present value of the lease payments is $100,000, which is 100% greater than or equal to 90% of the fair value of the roaster. Therefore, the lease does meet the present value test. And number 5, since the asset is returned to Coffee and Beans with some residual value, the alternative use test is not met. So if we walk through the arithmetic here, the present value of the payments, if we take $20,711.11 times the factor for that period, we get $95,890.35. And then the present value of the residual value at $5,000 is $4,109.65, totaling $100,000. The computation of the present value is rounded by 2 cents, so don't let that worry you. The rounding occurs because the tables of Chapter 5 are used to determine the amount shown. For homework and other computations in the text, we're going to use the tables, which might lead to small rounding differences. In practice, an Excel spreadsheet, worksheet, a financial calculator is often used to avoid these rounding differences, as frankly, I do. Okay, so the present value here, Starbucks is going to compute the lease liability and the amount capitalized as a right of use asset at the present value of the lease payments. So the capitalized amount That's $20,711.11 times the present value of an annuity due for 5 periods at 4%. And that's how we got in the previous slide. We got this $95,890.35. Now, on the date the lease is signed, Starbucks is going to record the lease on its books as follows: by debiting right of use asset for $95,890.35 with the same amount credited to lease liability. Note that Starbucks is going to record the obligation at the net amount of $95,890.35 rather than the gross amount, which is the $20,711.11 times the 5 years. On the date the lease is signed, Starbucks records the first lease payment as follows: by debiting lease liability for $20,711.11 and crediting cash for the same amount. Now, if we look at the lease amortization schedule, we'll start with $95,890, and our annual lease payments will remain constant, and the interest of 4% will be $7,665.20, and so the reduction of the lease liability will be $95,890.35. I think you follow that arithmetic. Now, what we'll do on the interest here for 4% on the lease liability, we're going to record on December 31, 2025, interest expense of $3,007.17 as a debit to interest expense, and a credit to lease liability for that same amount of $3,007.17. At year end, Starbucks is going to record the interest expense for the first year of the lease as follows, as shown. Now, if we look at the amortization expense, applying Starbucks' normal amortization policy, the straight line method results in the following entry at December 31, 2025. And we will debit amortization expense for $19,178.07 and credit right of use asset here for the $95,890.35 divided by 5, the same $19,178.07. So at December 31, 2025, they're going to report the right of use assets and related lease liabilities separately from other assets and liabilities on its balance sheet, or discloses its assets and liabilities in the notes to its financial statements. Starbucks classifies the portion of the liability due within 1 year or the operating cycle, whichever is longer, with current liabilities, and the rest with non-current liabilities. For example, the current portion of the December 31, 2025 total obligation is $75,179.24. In Starbucks' amortization schedule is the amount payable in 2026, or $20,711.11. And notice if I go back to the amortization schedule, here you see this and this, and note that the current portion is composed of two components. One, accrued interest on the liability outstanding throughout the year, That's the $3,007.17. And 2, reduction of the initial lease liability. Okay, so if we look at the balance sheet presentation, here the non-current assets are shown, the current liabilities are shown, and the non-current liabilities are shown. And for expenses, the interest expense, the lease liability, is shown here, and the amortization expense, right of use assets, is shown here. On January 1, 2026, Starbucks will then record the second lease payment as follows. And here we're going to debit lease liability for $20,711.11 and cash for the credit cash for the same amount. Okay, accounting for sales type leases. The lease classification tests for the lessor are identical to the tests used by the lessee to determine classification of a lease as a financing or operating lease. The lessor has, in substance, transferred control of the right of use asset and therefore has a sales type lease if the lessee takes ownership or consumes a substantial portion of the underlying asset over the lease term. On the other hand, if the lease does not transfer control of the asset over the lease term, the lessor will generally use the operating approach in accounting for that lease. Let's take a look at that in a little more depth. For sales type leases, 1, the lessor accounts for the lease in a manner similar to the sale of an asset. Number 2, the lessor generally records a lease receivable and eliminates the leased asset. And number 3, the lease receivable for sterling is computed as shown. And here's the formula. The lease receivable is equal to the present value of the rental payments plus the present value of guaranteed and unguaranteed residual values. All right, if we look at an illustration here to illustrate lessor accounting for a sales type lease, we're going to refer to the preceding coffee and beans Starbucks example. We repeat here the information relevant to the coffee beans in accounting for a lease transaction. So here they are. I won't go through them again, but quickly you see those that information. Now, if I look at an illustration for the lease payment calculation, the fair value of the leased equipment is $100,000. And the present value factor is shown here at 0.82193 of $5,000, and that gets us up to that $95,890.35 cents. 5 beginning of year lease payments earn a 4% return. So that's where we get those numbers here. And that's as we did before. So if the lease meets the classification as a finance or sales type lease because 1, the present value of the lease payments is equal to the fair value of the asset, and 2, the lease term is equal to the economic life of that asset. That is, Starbucks will consume substantially the entire underlying asset over the lease term. That looks like a good place for us to stop this video. And when we return, we'll take a look at a lease receivable calculation. Until that time, bye for now.